Hello, student. I am Dr. Shefali Jain, Assistant Professor, Tirthankar Mahavir University. Student, today we discuss about block one, the matters of the national income. In the previous video, we also discussed about the concept and the component of the national income. And in this video, we discuss about what is the method of measurement of national income. But first of all, I also introduce national income definition. National income is a certain term which is used interchangeably with national dividend, national output, and national expenditure. On this basis, national income has been defined in a number of ways. In common parlance, national income means the total value of goods and services produced primarily in a country. The total amount of income accruing to a country from economic activities in a year's time is known as national income. It includes payment made by made to all resources in form of wages, interest, rent, and profit. Now, in this video, we also discuss about the methods of measurement of national income. There are three methods which is used to measure the national income: prediction method, product method, and value added method. It is also called the value added method, prediction method, the predict method. Next, income method, next expenditure method. Now, prediction method. The sum total of the sum total of products produced in all sectors, all sector, primary sector, secondary sector, and tertiary sector, is the total output of nations. The next step is to find out the value of these products in terms of money. The money spent by Indian citizens working abroad is also added to this. Now we get the gross national income in a GNI, money value of total goods and services plus income from abroad. I have also discussed it, what is GNI, GDP in the concept of the national income in my previous video. So, measurement of national income by product is also called value added method. National income is equal to gross national product minus cost of capital minus depreciation minus indirect taxes. So, if we say in this method, the value, sorry, my cursor is not working well, I think. Um, huh. So, in this method, the value of all goods and services produced in the different industries during the year is added up. This is also known as value added method to GDP. GDP at the factor cost by history of origin. I have also explained about the GDP in the previous video. You can see here the concept and the components of the national income. The following items are included in India in this agriculture and aligned services, mining, manufacturing, constructions, electricity, gas and water supply, transport, communication and trade banking and insurance, real estate, ownerships of detailing and business services and public administrations, defense and other services for government services. In other words, it is some of the products added. The expenditure method is the most common way to calculate national income. The expenditure method formula for national income is C plus I plus G X minus M, where customer spending is denoted by C, investment is denoted by I, government spending is denoted by G, and X stand for export and import is represented as M. So, according to national income is the aggregate value of all goods and services used by firms in given financial year. Can we state that when the aggregate revenue generated by the firms is paid out of factors of production, aggregate income or national income? The national income can be calculated by using either of three methods, as you know. Now we discuss about the expenditure method according to Marshall. The labor and the capital a country acting on its natural resources produce annually a certain net aggregates of commodities, materials, and immaterials, including services of all kinds. This is the true net annual income of revenue or revenue of the country or national dividend. So, under the production method, we add the output produced or services rendered by the different sectors of economy during the year in order to calculate the national income. In this method, we include only the value added by each firm in the production process in the output figure. The value added method and production method is the used to calculate national income and different stages of the production process in a circular flow to represent the value added for each unit produced in the production process. Every organization adds value to the product which it buys from other firms as intermediate goods. The sum total of value added by crafting organization is the value of national income. Value added refers to the addition in the value of our raw materials or intermediate goods by an organization during the production process. Calculate the national income through the value added method. Differences between the value of output and the value of intermediate goods is taken. The value added method is the most commonly used method to estimate national income as it avoids double counting, which is major error while calculating national income. Value added method, value added is equal to value of output minus intermediate consumption. Example, it needs only flour to produce the goods. Now he purchases the flour from millers as intermediate goods worth rupee 30. Convert convert the flour into bread, uh, help of production activities, and sells the bread for 50 rupees. Here, flour is an intermediate goods, its value is 30. And based on the value of intermediate consumption, bread sold on the paper in the final goods, whose value is 50, and its standard value of output. It shows that the baker has added a value of 20 to the flow of goods and services in the economy. So, as discussion about the difference between the value of output and the value of intermediate goods is known as the value added. Value added is equal to value of output minus intermediate consumption. As जो फ्लोर था which is a baker take from the miller, it is 30 and the final goods था bread का 50 था, तो 50 minus 30 is 20. So The value added by each production company is also called gross value added at market price. Process total of all the gross value added at market price of all the prices of the country within its domestic territory during 1 year is equal to GDP. GDP market price includes domestic product at market price. So summation of GVA यानी gross value added at market price equal to GDP market price. Calculation of the components of the value added is intermediate consumption. The value of the use of intermediate goods during the production process to create the final product is intermediate consumption. And exchanges costs or intermediate goods are known as intermediate consumption expenditure. In the above example, flour is represented as the intermediate goods as it is used as a raw material for the production of the bread. However, any kind of machinery used for baking bread will not be considered as the intermediate consumption, as its value will be merged with the value of final goods. So, if the value of products intermediate consumption is already given, then the value of imports is not included separately. The calculation of national income. It is because the value intermediate consumption already includes the value of imports. However, if the question specifies the domestic purchases separately, then the value of imports will be added. So, second component of this method is value of output. The value of all goods and services within during a period of 1 year is known as the value of output. Different ways of calculating the value of output are as follows. When the whole output is sold in the initial year, and the value of output will be equal to the total sales of the output. Value of output is equal to sales when the whole output is not sold in the financial year, and the value of output then the value of output will be equal to the sum of sold output and the unsold stock of output. Here, the unsold stock is the difference between closing stock and opening stock, and it is also known as the change in stock. Value of output is equal to sales plus change in stock. Okay, change in stock is equal to closing stock minus opening stock. When the value of output sold is not given directly, then the value of output will be calculated by first determining the sales value. Value of output is equal to quantity multiply price plus change in stock. I think you have to understand what is the value of output. Value of output is equal to quantity multiply price plus change in stock. So, but export are not separately included. If the value of sales is already given, the value of export are not included separately. In the value of output, however, in the case of an economy, the value of sales includes both export and domestic sales. So there are many steps for calculating national income through the value added method as follows. The first step is to recognize and put all the producing units of an economy into primary, secondary, and tertiary sectors. Next, the second step is to calculate the gross fixed product at market price. Calculation determine the gross value added at market price for each sector. Of each sector, gross gross value added at market price given GDP at market price. So summation of the gross value uh, added at market price is equal to GDP market price. And now calculate domestic income NDP, net domestic product. Factor cost for the calculation of domestic income, the value of depreciation and net indirect tax is subtract from the gross domestic product at market price (GDP) market price. Net domestic product factor cost is equal to GDP market price minus depreciation minus net indirect taxes. So the final step is to calculate net factor income from abroad NFIA. To get national income, NFIA is added. The NFIA net factor income from abroad is added with the domestic income of the country. National income of NNP, net national product factor cost is equal to domestic income or NDP factor cost plus NFIA. So there should be some precaution also have to calculate the value added method. First of all, intermediate cost should not be added to national income, as the value of intermediate goods is already added to value of final products. They should not be added to the national income. The inclusion of the value of the intermediate goods again to national income will result in double count. Next day, transactions. Sales and purchase of second-hand goods must not be included. Value of uh, the value of second-hand goods should not be included in national income, as these goods are already counted in the year they were produced. Adding the value of these goods uh, will will also disturb the current flow of goods and services. However, any kinds of brokerage fee or commission paid on any transaction of such product should be included in the calculation of national income, as it is productive service. Next is self-consumption service. The domestic service production should not be included. It is difficult to find out the market value of domestic services like households, etc. So, production of domestic services is not included in the calculation of national income. These types of services are produced and used within a household as do not enter the marketplace. Therefore, are considered non-market transactions. However, paid services like maid, driver, etc. should be mentioned clearly in the national income, as their market value can be determined. And after this, self-consumption goods should be included. The production of self-consumption goods contributes to the output for final years. Therefore, these are added to the national income of any economy. However, these products are never sold in the open as their value is estimated. Next step, estimated value of house by people should be included. People live in their house do not pay rent, but enjoy the same housing services as received by the people living in the house on rent. Therefore, the value of the houses owned by the people is included in the national income. For this, the value is determined on the basis of an estimation of the rent of a similar house or accommodations in the market. This estimated rent is also known as imputed rent. Next is change in the stock or inventory must be included. The change in the value of opening and closing stock inventory and income is also included in the calculation of national income. In other words, the net increase in the inventory of an economy is included as a part of the total population in the national income. With it, double counting problem, a situation in which the value of an output when passing through its production stages is counted at once. This is double counting. A product passes through various stages of production before reaching the final stage. When the value of a product is calculated at each stage of a production, it is more likely at the cost of input more than once. This situation leads to double counting. While calculating national income, the problem of double counting occurs when the value of intermediate goods is also included with the value of final products. As I also give you example, I have also given example. Suppose a farmer produces wheat in his fields and sells it for 200 rupees to a flour mill. The miller then convert the wheat into flour and sells it to a baker to 500. Ultimately, the baker prepares biscuits from that flour and sells them to the consumer for final consumption at a price of 700. For farmer, wheat is final product 200 and he has not spent any intermediate cost. Therefore, the value added at this stage is 200. 200 for Miller flour is the final product 500 and he has spent 200 on wheat as an intermediate goods. Therefore, the value added at this stage is 300. So 500 minus 200 for the baker. The biscuit is the final product 700. Now he has spent 500 on flour as an intermediate cost. Therefore, the value added of this stage is 200. Now 700 minus 500. So by adding the value of output of the farmer से कितने का था 200. ओके उसके बाद मिलर ने 500 प्लस बेकर 700. नाउ वैल्यू ऑफ द आउटपुट कितनी होगी 1400. However, these value, if you see, however, these value of output consist of value of an intermediate goods. So the value of flour 500 consists of the value of wheat 200. Similarly, the value of biscuits 700 consists of the value of flour 500. So that the value of wheat and flour are counted twice. It means because it is seen 1400 once as the value of output and the other time as an intermediate goods. This leads to the problem of double counting. So double counting in the production method is a very need to avoid the double counting. So there should be take some precaution to avoid the double counting. So first of all, final output method. The method of final output says that only the value of the final goods should be added in the determination of national income. So in the above example, using the methods of final output, only the value of biscuits 700 at which these are sold. Final output says that only the value of the final goods should be added in the determination of national income. As in the above example, using the methods of final output, only the value of biscuits 700 at which these are sold to final consumer will be taken during the calculation of national income. With it, the method of value added says the sum of value added at each stage of production of final goods should be added in the determination of national income. So in the above example, as I have taken also example, sum of value added at each producing unit by the farmers, millers and bakers, but 200, 300 and 200 respectively should be added. Therefore, the value to be taken for the determination of national income will be 700 only. 200 plus 300 plus 200. Since the value of intermediate products is already included in the value of final good, we do not have to consider the value of intermediate goods in national income. If taken into account, the value of goods would be counted twice. To avoid duplication in counting, we can use the value added approach, which computes the value of final product plus the value of intermediate product at a pre-produced stage and then add them together to get the gross domestic product. The total of GDP at market price considered the monetary value is measured at market price. National income using the product and value added method can be calculated as well as types of production, um, which is shown in the screen. Medicines, cost price 1000, selling price 1500, profits 500. Okay, furnitures 1200, selling cost 1500 and profit 300. Clothes cost price 900, selling price 1300 and profit 400. Electronic equipment cost price 2000, selling price 3000 and profit 1000. Food items cost price 1800, selling price 2200 and profit 400. So total 6900 and selling price 9000, 9500. So profit 2600. So GNI is equal to total selling price minus total cost price plus income from abroad. So 9500 minus 6900, 2600. So, in this method, all goods and services produced during the year in various industries are added up. This is also known as value added to GDP or GDP at the sector of origins factor, cost factor. In India, include the following items: agriculture and aligned services, mining, development, constructions, and the supply of electricity, gas, and water, transport, communications, and trade, banking, industrial real estate, and property ownership of residential and commercial services, and public administration and defense and other services or government services. It is in the words the amount of the added gross uh, that added gross value. So, strength in this video, I have understood the product method, which is also known the other name value added method. And there are three methods. First of all, product method. It's also other name value added method, income method, expenditure method, and after that income method. But student, in the other video I will also discuss about the income method. और यहाँ पर अभी इस वीडियो को हम फिनिश करते हैं और नेक्स्ट वीडियो में आपसे द इनकम मेथड्स पर डिस्कशन करेंगे. नाउ थैंक यू वेरी मच.